Hey y'all, thanks for tuning in to TD Talks. Today, TD Talks with Peter Costa. Peter Costa is a former governor with the New York Stock Exchange, a CNBC market analyst, head of the Costa family office, is on the advisory council at Meridian Wealth, and also writes Costa's Corner newsletter. I'm a huge fan of the newsletter. That's how I originally got introduced to Mr. Costa. I love his newsletter. If you don't subscribe to it, you've got to. But I'm here to have a great conversation today with Peter Costa. Peter, thanks for joining.
Oh, thank you for inviting me, Tyler. I really appreciate it.
I'm uh, I'm really a big fan of the newsletter. That's how I was, like I said, first introduced because I love the way that it's not just numbers and data and basis points and all these discussions. Pretty much everything else we see in a lot of literature about wealth management and economics and all the rest. Yours has some actual personality. What was it that led you to take that differentiating approach to a newsletter?
Well, a couple of things, Taylor. I subscribe to several different newsletters, and some of the people that I subscribe to are personal friends, and they just, drone on about the numbers from last week, this week, next week, and so on and so forth. You can get that on the internet. You don't need some talking head to go over the GDP numbers from the first quarter. What I like to do is, I have a personality, so and anybody who knows me, that it it's I have a personality, and I like to um, put that into my writing. So when you read my column, it's not professionally written, but it's like you're reading something that I wrote. I mean, right away that this is the type of writing. It's more very personal, and I like to think it's intimate, so you see inside of what I'm thinking, and you also see that, I admit that I don't know everything, and, this is only an opinion. And I think that's one of the things that really got me going is that there weren't a lot of people, they'll give you their opinion, but they never want to hear the other side. So I will listen to the other side. I do listen to people who disagree with me. And there are times when I've gotten replies where somebody who I know and trust, got back to me and said I was 100% wrong, and he explained it, and I learned something. So to me, you can read my column, maybe learn a little bit. I do give occasionally I give some background to the trading floor and how trading actually transpires, and like there's things in there as well, but they're also, um, you know, I want to learn. I'm 67. I don't mind learning. I think the value of getting up every morning is if you learn something new, it was worth getting out of bed. So that's why, one of the reasons, or one of many reasons, I write that column. And I'm
Yeah.
glad you enjoy it.
Yeah, absolutely. I recently heard you in another interview um, talk about people who read markets or make statements about markets or judge markets based on political affiliation. We'll see, a politician talk about how we need fairer trade for decades, and then tariffs are announced, and then all of a sudden they're against what could potentially bring fairer trade, and vice versa. You have Republicans who talk about how there's this, pending recession and then when political power changes, they cool off on that and talk about it, how everything's changing. And I think a lot of people feed off of that and take that approach. What's kind of your guidance or advice to somebody who makes their reads on the market based on a political affiliation?
Well, it's, you have to be aware of maybe 10 years ago, the political atmosphere might be very similar, but the political atmosphere did not guide or was not a major force as far as markets were concerned. So you do have to be aware of what is coming out of the White House, because it definitely impacts markets, but not necessarily, I mean, long term, who knows? But you have to understand that when political winds blow to the right or to the left, a lot of ships go in that direction because they don't want to be fighting any kind of tide, or what the paradigm is in this country at that point. I mean, politicians, let's be totally honest, their number one concern is being reelected. So if they're following in a popular path, the chances of getting reelected are higher. And, because the White House has determined that this is the path we're going to go on, I'm obviously as fits and starts, a lot of people are moving in that direction and agreeing with it. I will still stand by my feelings that I don't think tariffs are actually the right way to go. I'm a little bit, I mean, I was dead set against them because I didn't think that a tariff or any kind of trade war would benefit anybody. But after, going through it and listening and doing a little more research and trying to like gauge my feelings as opposed, regarding the tariffs, I'm not that much opposed to them. I do think that there is um, a lot of good for the country can come out of it, even though, as President Trump had said, there's going to be some rough patches, and I think everyone's expecting that. But at the end of the day, I think that there are a lot of things. When you have strength in negotiation, you're probably going to win that negotiation. All right, and the U.S. has strength in any negotiation they have with anybody because of the power of the consumer in this country and the power of the economy. So you get them to the table, you negotiate, and this is what President Trump does. I don't know if he's good at it, but he does it. And, you see where it goes. And I think that, at the end of the day, or the end of maybe this year, we're going to have some very positive results from this. Now, returning manufacturing to the United States, I mean, you have to really gauge on what manufacturing you actually think you're going to get. But we will have, I mean, money is being invested, more money is being invested, internally in the U.S. So, that's a good thing. I think there's a lot of good things that are coming out of it. There will be some rough patches, and I do think the political wins, when they shift to the right, a lot of people follow it, and then if, God forbid something changes, that's normal though. That's been normal for forever. So
Yeah.
I don't think there's anything exceptional as far as the political wins are concerned. But I do think the Trump presidency has been exceptional. I mean,
Yeah.
there's a lot of things in there.
If you were sitting in the Oval Office and President Trump said, Peter, you're fabulous, you're handsome, you're the greatest ever I've heard. Tell me, what do you think I should do? What would be your talking points, Tim, to guide him through the remainder of this presidency?
Well, you know what? I think one of the things that concerns me, Taylor, is inconsistency. I think that, you have clarity, which is still up in the air, but the inconsistency of the message to me, I think that the administration should be very consistent. I know that, if you look at the big picture, they definitely are. But when you're an investor, you want the clarity, number one. Number two, you want consistency of message. And I think that you're rolling back, tariffs and saying that, oh no, tomorrow, if Macron doesn't agree with me, I'm going to put a 90% tariff on, French baguettes. You know what I mean? So to me, it's more about being a consistent message, staying on point, which is very hard for President Trump. And, moving forward, he's got great messages, but he should stay on point. And I think that's where I would start there. I mean, there's a lot we could talk about, but I think that would be my number one thing. That's my biggest concern with the administration. Um, you know, but that's if you're really going to look at it, that's more of a micro situation as opposed to the macro. I think the macro is still very clear of where he wants to go and what he's trying to attempt. So
Yeah.
the macro part is still good, but the micro part, which is that short term, I think that's what, I want to be, I want a little more consistency.
Yeah. What, from what you've read so far on the, big, beautiful bill, this, budget bill, what are your thoughts on that so far?
Well, it's funny you mentioned that because that is part of my column tomorrow on Costa's Corner. Um, what, first off, it's not a big, beautiful bill. All right. From what I've seen, it is, and I could be wrong, and I would gladly listen to people tell me I'm wrong. But to me, it's almost like the Democrats wrote this bill too, except for it's penned by Republicans. But it's the same idea: spend more money, increase taxes in one place, decrease taxes in another. Very similar to what the Democrats have proposed in the past. At the end of the day, with this big, beautiful bill, our deficit's going up, and I am a fiscal conservative. I would lean towards, I mean, I don't know if there's anything lower than conservative. There's got to be something lower than that. But I think the government is does not need to be spending trillions of dollars. And you know what? Getting us further in debt, obviously, if you look at the way the dollar's been trading over the last month, it's not a good thing. And I think that's where the bill falls very, very short of what I would want. But I mean, there are a lot of positives in there. There's a lot of good pieces, and like any bill, and this is since the 1700s. You give something, you get something. You get something, you give something. And I think there's a lot of that in that bill. There are things in there that probably should never be in there, and that goes from both sides. So I'm playing it very fair here. Both sides have a lot to reckon with as far as where the spending is going.
Yeah.
So I'm not a big fan of it. I think it needs work, and I think both sides have to say, no, we don't need to spend $33 million, building a bridge that nobody's going to use. You know what I mean? So there's a lot of, well, my district needs it because we need employment. You know what? The private sector should, if the private sector has the ability to build and do whatever the private sector does, it can take up a lot of the room that the public sector doesn't. So that's my feeling, is that I'm more about lowering taxes for corporations and keeping interest rates down. Companies are going to spend, they're going to borrow, and they're going to build. To me, that gets you out of any problems you have with
Yeah.
corporate America and small businesses having the availability of cash and regulations. They will build.
Yeah, I don't think that the average, person who shares a Facebook post about how the bill is really good, especially if they're a big MAGA person and they're just sharing it and they just go along with it or whatever. I don't think that the average person really understands the damaging effect of having a deficit where we have to, print more money via, selling these bonds to central banks. There's more cash in the system, but it's not going in their pocket. It's just
Right.
going into the system, which resets those prices. If you're talking to somebody who goes, "This bill is good, it does the right things," how would you communicate to them the damaging effect of how this, in and of itself, is going to further make inflation, problematic for the average American?
Well, that's a tough question to ask because if you look at almost every bill that's ever been written, that's been a problem. So, it's not like anybody in this country, and this is any government official or even business person, really accepts the fact that we have a debt problem. There are a lot of people that talk about it, and I'm going to be totally honest with you. I've never seen one person ever come up with an actual plan that won't destroy the economy. And so we're in a very, very tough spot. It's always been a case of kicking the can down the road as far as let the next administration deal with this debt. Well, we can always print. The Chinese everyone is always assuming everything is going to remain the way it has been. You have the Chinese who will take $300 billion worth of US capital and buy US bonds. So there's always an open market as far as internationally. Um, but it's becoming harder now. As you've seen, the bond market it's becoming difficult, and I think that might really gum up the gears for the next couple of months as far as getting this bill passed, paying, distributing money. It's going to slow things down, and then people. I don't think there's anybody who really truly understands the full scope of everything, and that's one of the things. And if you do understand that full scope, which the Fed probably does, they have a hard time communicating it where you or I will understand it, or where you'll get the impact that's required, like saying, all right, well, my income taxes, my personal income tax is going to have to go up just to pay this, or we're going to have to do something else or cut some sort of spending somewhere, defense spending or whatever. It's very, very hard, and I don't have an answer for it. I wish I did. I mean, if I did, I'd probably make millions. But the fact is, I don't think anybody really truly has an answer. I think they know what the problem is. They just don't know what the real solution is, and that alone is something that people should be afraid of. Is the fact that there are no real solutions to this. I mean, other than drastic measures and no politician ever wants to put through drastic measures because they'll never get reelected. Going back to my first point, that's the only reason they're there. So yeah, it's going to be a very rough go. Um, I would love to see at least this big beautiful bill cut back where it doesn't really impact the debt. So, but then that cuts a lot of the things in there. I mean, taxes are going to be changed. It's going to be a major problem, and I think we're getting close to a point of where it's going to actually become a significant, impediment to growth.
Yeah.
And there's no
Yeah.
doubt.
If we were to assume that these trade deals are going to be worked out and they're going to be negotiated and it's going to be a good fit for America, and we kind of get past the effect of that whole discussion has had on the market, um, what impact do you think a military conflict with Iran or with a even further escalation with Russia could have on markets?
All right. Well, I mean, this is something. If you reach back into my library of articles that I've written, one of the things. I mean, this is from 37 or 38 years of experience. Geopolitical events generally have a very short shelf life as far as markets are concerned. Yes, invasion here, all right, market goes down 1,000 points. You have whatever the situation is with Iran and Israel or any of their partners, it definitely has an impact because of oil and whatnot, but it's still short. I mean, relative to the event itself, like when the Russians invaded Ukraine, markets took a real hit. Oil market got destroyed. A lot of things were happening, and then 2 weeks later, let's negotiate. Or all right, what do you want to buy now? You know what I mean? So it doesn't last long. Um, with Russia or with Iran, I think that if there's any kind of nuclear situation, that could be a problem. We don't know. I mean, that's an unknown. I think that'd be significant. But again, um, more than likely, it would be a shorter time frame as far as the impact on the markets. I think something with China and Taiwan and the U.S. and the Far East, that could possibly have a much broader effect in the longer term, only because they're our number one or number one or two trading partners. And you know, you're talking about the amount of money that flows between China and the U.S. It's significant, and if there's any kind of military action as far as in the Straits of Taiwan, a lot of the money will stop flowing to China, and a lot of the product will stop flowing to the U.S. So I do think that would be a much broader and much more significant event. But any of these other events that potentially could happen, especially with Iran, I got to believe that it's a short term. It would be a short term hit, and as a trader, that's a buying opportunity. So
Yeah. For somebody who's, let's say somebody who is younger or middle aged, they've got a decent time horizon until retirement. In times like where we had the sell off from tariffs, or we were to have some sort of military conflict like that, another geopolitical conflict like that. And you kind of just said it there as a buying opportunity. What is a good way that you believe in communicating that to somebody who's so paralyzed by what the TV is saying, and they're like waiting for the bottom, as opposed to maybe buying on the way down with liquidity?
well, I think that if you as a wealth advisor or any wealth advisor or anybody who's investing um, has a longer time frame, the overall investing in equities is overall is going to be better than investing anywhere else. I mean, you're going to have these blips where there is going to be some sort of sell off where it's significant. And I'm not a huge fan of this because I do things differently, but dollar cost averaging works perfectly. If you're going to put away $1,000 a month, there are going to be times when that $1,000 is only going to buy a very small portion of what you want, and there are going to be times when it's going to be significant. So to me, as steady as she goes. I've always said that. Don't get panicked by anything. We went through COVID, and to me, if the markets rallied beautifully. I don't want to use President Trump's term, but they really came back unreal because once there's clarity, the economies generally expand at a certain rate, and with that, technology allows us to invest or have new places to invest or new companies to invest in, there's always going to be interesting things to do. You as an advisor and all people at Meridian, anybody, the best thing they can do is just keep everybody calm and keep looking for opportunities. Right now, if I was going to tell you that my portfolio is about 50% cash, we tell you that I'm not 100% sure, that I feel the markets are not going to be, I think we have an opportunity at some point during the next 6 months. I do think we're going to have some sort of very minimal recession, and I think there'll be an opportunity, but my time horizon is much shorter. But over time, you're going to do better investing in equities. Some days are going to be better than others. And the other thing, one of the most important things that I always is, yeah, don't look at your portfolio every day. All right. Number one, it's paper, right? Until you sell it, it's really just paper. It's value that has a signed number on it, but it's not effectively, you're not taking all that money out tomorrow. So when they look at their portfolio and it's down 7%, they're screaming at you or screaming at their advisor or anybody. The fact is, you don't need that money right now. All right. Yes, you have less of it, but it will rally back. If you look at how much money you put in and where you are right now, you've done very well, even with the ups and downs of the market. So to me, it's a short-term thinking. If you need the money, that's one thing. Yeah, you get a little panicky if you want to buy a house or a business. But the reality is most people, even when they get to retirement age, are not taking all of that lump sum out. So their portfolio might take a hit. Even at 65, 67, it might take a hit. But you're not using all of that money. You're only going to need whatever the number is that you have in mind to live a comfortable lifestyle, and at some point the markets will rally and you'll still have value added. You've had value added from the minute you put your money in. So just keep them calm, give them a shot of nice, what's the latest bourbon you guys drink? I don't know. Give them a Maker's Mark 46. It's cheap and it's good. Or a Blanton's, a nice Blanton's. They won't even know.
I love that. You've been you're a career veteran. You've seen all sorts of different events, economic events, geopolitical events. But for somebody who is, younger and they've maybe seen COVID and they've seen tariff talk, they see these things and they think, this has never happened before. How will the market recover from this? This is a once in a lifetime thing, and they're paralyzed by that fear. What talking points do you have for somebody who hasn't seen a ton of market history and seen markets recover?
Well, you know what it is? I'm big on historical movements because if you really look back, everything that's happened before has happened now. You know what I'm saying? That it might have a different name, but there were events, World War II, for example, the crash in '87. There's a lot of events that if you're just coming into the game, I've never seen this. Well, there's always been something, and that is just the nature of investing. Investors are lemmings. They 20 people buy something, then 2,000 people buy it, and then 200,000 people buy it. It's very typical. They just have to really look at the historical context of what just happened. COVID was unusual because we've never seen anything like that. But if you look at the way the market reacted and the way it rebounded, that's not any different from the crash in 1987. I think the time frame in '87, it took, I don't know, I don't remember how many months, maybe 6 months to get that back, or a little bit less. Actually, I think the market rallied probably 3 months. This took less than a month and a half to basically recover that ground. So with that in mind, I mean, things happen now. I think things happen faster, but they also recover faster. So that's something that they should kind of be prepared for. And I think, anybody who's going to educate investors, you have to educate them both ways. If the market goes down 20%, in 6 months, it might recover that in 3 months. It's more than likely that with the speed that things recover, their recovery will be fast. So, it's just about looking at a historical context and then realizing that you can compress that in a shorter time frame, and you're going to see the same thing happen. So,
Yeah.
and if you look at it historically, you can go back and look at all the different. I mean, there are times where you might have had a much longer recessionary period, and the market has been basically flat or down for a much longer period. That's one thing, but we haven't seen that. We haven't seen anything like that in probably since the 50s. So or excuse me, the 60s. The 50s were great, but the 60s were a little bit tough. But you look at it, and you look at the historical nature of trading. It's the what's old is new, and what's new is old. So I don't think anybody should ever get like overwhelmed by movements in the market anymore. I think
Yeah.
whatever goes down will go up. It might, depending on the individual investment, though, that's a different story.
Yeah.
Companies could be having problems. That's where, you have to be aware of where you're invested. And, if you're in an ETF or if you're in a mutual fund, you have to be aware of what's going on.
Yeah. Last question here. Just reading off your bio, you are having and have had an outstanding career in the investment world and the things that you're doing now, still actively. If you could go back and start all over or talk to somebody who was starting, at the same age that you got started in this industry, what would you say you did really, really well? And what do you wish you could go back and maybe do better?
That's a great question. I think I was very fortunate to land a role on the trading floor of the New York Stock Exchange at the time I did. You can't do that now. Doesn't exist. But I was very fortunate. I was very lucky. Timing is, people don't want to talk about luck or timing, but I look at my career, it's luck and timing. Granted, I learned a lot and I became a professional. But to me, I think one of the most important things for me and my success was that I had mentors. And I think having a mentor and having somebody who's gone and had the experience that you're looking to have was instrumental. I've had three of them, or two or three of them, and without them, I'm not sure if I would have ever succeeded. I mean, I was lucky, but I still had somebody in my ear saying, "You really want to do that?" And I think that's important. And even in this day and age, where everybody is so removed personally, or intimately, you talk to how many people a day? I mean, you talk to a lot, but there are a lot of people that are on their phones all day long. They don't, they should have somebody that they can go to who's been through what they're about to go through. And I think that becomes very helpful. And it's tough because you have to be able to trust this person too. So it's a tough thing, but I recommend getting or having a mentor, or at least accepting someone as a mentor as they move through their career. And then at some point, they can be a mentor to somebody else, and then,
Yeah.
they pay it forward. So I think that's would be the thing I would advise. I think you can't go wrong.
Yeah.
Yeah.
Well, that's wonderful advice here for listeners. So, Peter, thanks so much for joining us today. Everybody, you will be able to listen to this recording of the TD Talks podcast on Apple Podcasts, Spotify, and also YouTube. Peter, thank you so much.
Taylor, thank you for having me on. Have a great day.
You too. Bye-bye. The views and opinions voiced in this podcast are solely the views and opinions of Taylor Davis and do not reflect the views or opinions of any other entity or organization. The content provided is for informational purposes only and is not meant to be specific investment advice for any individual. Please consult with your financial advisor to address your unique circumstances. Taylor Davis does not provide legal or tax advice.